Fantastic. Thanks very much, Tim, and thanks for the opportunity to present and welcome. Right, we might jump straight into it if we can. So the important notice and disclaimer, please read that at your leisure. So where we'll kick off today is just some of the key financial highlights in terms of FY21. We had an improvement in our underlying EBITDA, up 22% for the year, which we're very happy and pleased with. We've been able to expand the margins within our business. So our business is now achieving a 30% margin, up from about 19% 2 years ago. We've had a substantial improvement in our net operating cash flow, and that's allowed us to continue to increase our dividends for our shareholders. In fact, for the full year, FY21, our dividend was up 56%, and the final dividend was up 60%. Importantly, we've also forecast that for the FY22 year, we expect dividends to be up a further 40%. So we have the right momentum in terms of the development of the profits within our business, the cash flow, and therefore the dividends for shareholders. So revenue was up around about 4%, and expenses were down 3%. So we have those nice positive jaws in terms of the things that are driving that margin improvement. And we've also been able to reduce our debt profile. So our debt is now 1 times underlying EBITDA. So overall, the business is in a really strong position, and we're very optimistic about what FY22 will hold for us. But let's just dive into a little bit of detail about what Prime is all about. So if we could go to the next slide, please. So for those of you that haven't actually heard of Prime, and Tim did a good job of introducing it, we're a professional services firm. We operate across Melbourne, Sydney, and Brisbane, which are our core hubs where our ideal clients are, and also where the talent resides that we want to work with. We have around about, now it's up to 106 team members in those core locations, but we're also building out our back office services through our Manila operations as well. But our core proposition in terms of what Prime is trying to do differently within the professional services space comes down to ultimately offering multiple services to our clients through the one experience. That's our one connected mandate, if you like. So we're in a nice position. We've got a growing market share, and we see great opportunities for the future. We might just flip on to the next slide. So in terms of how our revenue is broken up across those 4 key service lines, which are 2 segments, we have the accounting and business advisory, including capital segment, which makes up 59% of our overall revenue of $22.3 million. We have 41% is wealth management and SMSF. We currently manage around about $1.1 billion for clients, and the typical client within the wealth division is around about $1 to $3 million of funds under management. Importantly, if we look at that top left-hand corner of this slide, 78% of our revenue is driven off the back of our own brand with our own interactions with our own customers, and 22% comes through joint venture arrangements we have with other accounting firms to help them deliver some of the services that we offer that they cannot offer themselves. So we have some distribution by virtue of that. That gives us a little bit of growth opportunity there. But overwhelmingly, you'll see us continue to drive more revenue off our own interactions and developing all 4 service lines. Please go to the next slide. So some of the peer comparisons that we have, and Tim has highlighted, we've got about a $28 million market cap at the moment. The companies that we compare ourselves with are on the sort of the middle part of that slide there, where we have Kelly Partners Group and also Count Plus. They're most similar to what we do, but we fit within that overall segment there that has been listed. Our reported earnings per share is 1.69 cents per share, and we're trading at around about 8 times at the moment, which is approximately half what some of our peers are trading at, and probably a third of some of the others. So we think there is an opportunity for some upside within the business and the share price. We have a good, strong dividend yield at around about 5% at the moment as well. So moving on to the next slide, please. So this is some of the stuff that I've already touched on in terms of the shape of our revenue. So $22.3 million, up 4% in FY21. Underlying EBITDA of $6.8 million, NPAT of $3.1 million, EPS I've covered off, a final dividend of 0.4 cents per share. That's paid in the first week of October, and an overall dividend of 0.7, moving to 1 cent per share in FY22. On to the next slide, please. So just to look at that shape of that revenue in a little bit more detail between FY20 and FY21. So accounting, business advisory and capital has been growing at around about 10%. We see that there is a great opportunity to continue to build out our capital or corporate advisory service, which is typically for businesses that have a value between, say, $20 and $120 million. We think that that division can grow from around about $3 million at the moment up to sort of $5, $6, $7 million plus over the coming years. And also when we look at the second segment there, the wealth management and SMSF space, for the first time in 3 years, we can really see an opportunity to start to grow, particularly the wealth management division, into the double-digit revenue side of things. We see that happening through a greater focus on wholesale clients and also how we can internally generate opportunities from our existing accounting client base into wealth management and SMSF. So we have a really unique opportunity to not only drive growth in revenue through cross-referral, which is a core part of our strategy, but also each division being able to get their own new clients as well. So we see that we've got a couple of different avenues there to continue to grow our business. Our goal on a 3 to 5 year basis is to push our revenue through to around about $40 million from the current $23 million. Here you see the shape of the revenue growth over the last 4 or 5 years. So between 4 and 10%. We are optimistic about FY22 being at the higher end of that range that we've had in there previously, and we'd like to see that come in at double digits. So moving on to the next slide, if we can. So not only are we looking at the organic growth from new clients and new services for existing clients, but we're also starting to tuck in some of the inorganic growth opportunities. So actually bulking up the teams that we have, those 4 core teams. And recently we undertook a transaction with a business called Alpen, where 2 or 3 of their team members joined us as part of bringing their revenue, their contact, their network base in to our audience, and also offering some of the skill sets that they have to our existing client base. So that's around about $1 million of revenue that they've been able to achieve in the previous 2 years, so each year for the previous 2 years. And that fits in nicely as part of our growth towards that $40 million revenue target. On to the next slide, if we can, please. So we have been in a strong position in terms of managing our cost base. You'll see there between FY19 and FY21, we've been able to reduce expenses by 6% in FY20 and then a further 3% in FY21. So we have a strong control over our cost base. We've done that by virtue of centralising a lot of the services for finance, HR, IT, marketing, etc. We're also getting a lot of leverage off our IT system, which is allowing us to identify where opportunities are for improvement, not just at the revenue level, but also around how we manage costs as well. We also have the offshore team that is building. That offshore team was probably only around about sort of 5% of our overall team member numbers, say 2 years ago. That's now up to around about 21% of our team. So in terms of the underlying EBITDA, we had a 22% improvement, as I mentioned before, in FY21 and a 7% improvement in the previous year. We've now had 3 strong years of improvement on that front. Moving into the next slide, please. So I've touched on the margin improvement, but from 19% to 30%, which we feel is a very sustainable margin for a business like ours, and probably top quartile, that's what we will continue to target for the following years as we grow out our revenue base. Our operating cash flow, as I said earlier, is very strong in FY21, up to $5.5 million from $1.6 million in FY19. That is providing us with opportunity to continue to improve dividends and reduce debt as well. On to the next slide, please. So dividends, I've mentioned a number of times, it's a key theme. At the moment, we're currently paying out about 41% of our reported NPAT for members, shareholders. We do have a DRP as well, but we are targeting to be able to pay out 40 to 60%. So at the moment, we're at that bottom end of the range, and we see that can improve. And so what you see there in the bottom right-hand side of the slide is what we are forecasting the dividend to increase in FY22. Next slide, please. So I mentioned before how we've been able to manage our cost base very strongly over the last couple of years. I think it's important to note that we've been able to do that in obviously a difficult environment, but also without hurting the service that we deliver to our clients. So one of the things that we measure ourselves as part of our balanced scorecards for all team members is the feedback that we're obviously getting from our clients. That's a key part of having them be advocates for the future. And one of the things that is used quite commonly is a net promoter score. So we actually surveyed our clients over the last 18 months, and we've seen substantial improvements in those scores. We've actually seen them move from 39 to 54 within the accounting and business advisory division, and from 29 to 41. So we have a very strong focus on what we do for our customers and for our clients. And over that difficult period, we've still been able to improve how they have been rating us. And just to put that in perspective, a net promoter score can be as low as -100 to as high as +100. And at the moment, the range that we sit in, as you see in the bottom right-hand corner, is considered great. So anything above 30 is great, which means that we're in a nice position. Clients are valuing what we do. And obviously, we haven't been able to service clients in exactly the same way, be it face-to-face, as we would have previously. Moving on to the next slide, if we can, please. This is the final slide that I'll cover off with a bit of detail. So in terms of our outlook, we expect to keep the same momentum that we currently have. We want to increase our earnings and our revenue into FY22. We'll keep looking for those inorganic growth opportunities, and we have a few of those that we are in continued discussions with now. Dividends are a theme, clearly that we see those increasing. Debt coming down anywhere between 0.5 to 1 times. Capital management initiatives we have raised. We raised this at our FY21 presentation. We put a buyback in place in the middle of this week. That gives you an indicator as to how we see value from our current share price. We'll continue to align shareholders in the team. 42% of our company is owned by key management staff. Our staff are our biggest asset. We want them to continue to be aligned with shareholders. We're also reviewing our existing board structure. We want to bring on another independent director to that structure, and we'll keep prioritising our people, obviously client service and compliance as well. So business is in good shape, Tim, and I'm very pleased to take any questions that we might have just around where the business is at and where we're going.
Thanks, Simon. It's a very attractive, fully franked dividend deal. Start with that. Now, this whole industry has grown through acquisitions, and you spoke about growing your wealth management division, if you like. Are acquisitions on the table?
Yeah, look, I think those inorganic opportunities, I think it comes down to the culture and the selection of the people that are attached to that. So we've got a great team at the moment. We've been able to drive this philosophy about delivering more services and value to our clients. And I think if we can find more people like we just recently did that have that same philosophy, that don't just look at their own particular skill set, but the totality of what we can do for clients, then absolutely we will look at that. But it won't be done on the basis of putting the balance sheet at risk at all. So we've been conscious of reducing debt, but increasing alignment with shareholders and the key management and staff within the business. So we'll look at them, but we'll be pragmatic and careful.
And the core of the employees you have here, are they financial advisors or are they accountants?
Yeah, so it's probably an interesting split. We've got around about 40 accountants of our 106 staff. We've got around about 30 that fit within the financial advisory team. There's about 10 in the corporate advisory. The SMSF team has around about 10, and the rest are head office team members, or those placed overseas.
And you were talking about your kind of core customer being $1 to $3 million under management. Is there a way the industry can service the smaller investors, if you like?
Yeah, it's a tough question to answer, because the cost of compliance within wealth management, which makes up around about 40% of what we do, has clearly gone up. And it's a different environment. So I think, look, ideally you want to be able to deliver services to anyone that has the capacity to be able to pay for them. But what you're finding is that there are minimum costs now coming into the whole advice space. In our case, it's a minimum cost of $5,000 for any new client. And so it's not necessarily just driven by the size of the funds. And we are also pushing up into a higher bracket of high net worth clients. Recently, we've had quite a few clients that have joined us between $5 and $20 million of assets under management or funds under management. But our typical client, if you like, is a business or business owner or a family group as well. So we A typical client on the accounting front is probably paying a fee between, say, $10,000 to $20,000 a year. And the wealth is probably between $5,000 and $10,000 a year. And importantly, about 80% of our revenue is recurring in nature.
And just time for two more quick ones, if you like. While the cash position is excellent, will the DRP continue after the final dividend?
Yeah, so I think it's important. We've had shareholders have participated in the DRP for the last 2 or 3 years. We don't see any reason to reduce it or get rid of it. We had a discount previously on it. There's no longer a discount on it, but we think it's important to provide people that opportunity to continue to reinvest.
And finally, liquidity is an issue in your share price. So how can you manage that better, if you like?
Yeah, look, that's not an easy one to answer. Obviously, there's a finite number of shares on issue at the moment, and interesting, liquidity has started to improve a little bit over the last month or so as we've been out showcasing our results. But look, it's not an easy one to answer. There is obviously key alignment with management in there, and that's not probably a part of the pie that will move on. So there is a small amount of shares available, but look, I think the key thing is to just get on the bid and see how you go.